Hey everyone, I got an exciting show for you today. One of the most common questions I get or requests from my audience is, hey, bring on some more CPAs. So thanks to our network, thanks to the subscribers of One Rental at a Time, we've been recommended to bring on Evan Kirkpatrick. How you doing, Evan?
Good. How are you doing today?
I'm doing really, really well. So why don't you introduce the audience to who you are, where you're at in this country, a little bit about you and your practice, and we'll get into some pretty interesting topics today.
So I'm Evan. I run a practice, Kirkpatrick CPA, here in the suburbs of Austin, Texas. So super hot real estate area. Lots of activity here. Lots of people here wanting to invest in real estate. I've been a tax guy for my entire professional career. I've been a CPA for nearly a decade now. This is all I've ever done in life to make money is CPA stuff. And we work with a number of people, a number of real estate investors, different places in the spectrum down their real estate journey, a number of businesses connected to real estate, agents, brokers, a number of subcontractor types, various just people that are connected to the industry in different ways. Also work with some other small businesses. And in my past, I've worked for bigger accounting firms, and I've worked for those firms on even bigger real estate connected entities. I've worked with some on the tax side for some pretty big developers, also kind of helping them on the cash flow side also as an external accountant. So I've done syndicated deals. The biggest one I've done was like a 5,000 acre master plan community outside of Houston, which there's all sorts of fun complications that come into that. But these days we don't necessarily work on stuff quite that large. But working on, some small scale syndications, a lot of individual investors investing in different stuff, single family, duplexes, quadplexes, small multifamily, commercial, you name it. I've kind of touched it at some point.
Very cool, Evan. Well, we're going to do this at the end, but why don't we hit it now? Because again, really CPA is one of the most common requests I get. If somebody's looking for a CPA for their business or they're in real estate investing, how would they get a hold of you? And we'll do it again at the end.
You could call our office at 512-246-9669. You can always reach out to me, Facebook, LinkedIn, connect with me and shoot me a message, or you can email me at ekirkpatrick, so EKIRKPATRICK at kirkpatrickpllc.com.
And don't forget that P. I actually forgot that on a Zoom invite this morning. I'm like, oops, I missed that. So it's PLLC. And
unfortunately, we have to be a special kind of LLC for us professional types. So don't forget that one.
Don't forget that. So I will put your email as the first line in the description in this video if you're watching. So you will have it because I did mistype it, and I will make sure you don't mistype it. So, okay, now that's out of the way.
Yeah, unfortunately, I'm blessed with this long last name. So what you going to do?
What you going to do? That's okay. So we're going to talk about a couple of different topics. We're going to definitely spend some time about some accounting 101 or nuts and bolts, meaning depreciation, cost segregation, all of that. We're going to hold that for phase 2 or step 2. I was really intrigued by the fact that, you're willing to talk about deals, right? You're seeing at least, pre-health event, people bring you deals and you tell them the truth, right? It's, hey, this doesn't make sense. What are you trying to do? So I thought we should talk about that, right? We both see lots of bigger pockets people coming on and they think it's easy and, oh, by the way, just rinse and repeat. And whether it's BRRRR or out of state or syndication, and it's not as easy as these social media types want it to be. So I was intrigued by that part of our quick introduction, and I thought we should talk about it.
Yeah. So let me preface this because I get asked all the time, do you invest in real estate? Do you invest in real estate? And the answer is no, for a couple of reasons. One is that the reality is that the skills I have on the financial side are just more valuable than me spending my time trying to figure out how to do the same things a lot of other people are doing. And I can help more people by using this knowledge than I can by just, trying to go out there and then figure out like, how do you change carpet in a house and stuff like that. So what I can't do is if you give me a bunch of photos, I can't tell you, okay, this is how much it's going to cost to rehab this house.
Right.
That's not what I can do. But what that allows me to do is I see all these deals from the number side.
Yes.
When we're dealing with real estate, people are in real estate to make money at the end of the day. There's not a lot of people are like, I really just want to go look at a bunch of stinky houses and tear out a bunch of moldy carpet because it just makes me happy to do that. There are some people like working with their hands, and that can definitely be a factor in this.
Sure.
But it's ultimately like, hey, I'm trying to make money so that, I can have financial freedom from my job, so I can support my family in the long term, that I can build wealth for myself and for my children. And so I'm kind of blessed with the opportunity to see all these deals when it comes down to what the numbers look like.
Mm.
And what you see, I think, with the people that have a lot of excitement early on is that, you know, and I do this too. I do this too with different things I see in life where it's like, here's this new opportunity. Like, okay, this seems really awesome. Let's go. This is going to be straightforward. Like, you know, I figured something out that other people haven't. Right now, these days, with the internet and with the economic run-up we've had, if there's an opportunity out there, you know, other people have figured it out, right? There's so much competition around here. I talked before a bunch of real estate meetups and groups like that. And there's so much competition for deals. There's so many people trying to get into real estate. Or at least there were up until a few months ago. And we kind of have to talk about this holding what's happened in coronavirus time relatively loosely. But there's been so much money chasing deals. There's so many people want to get into real estate. There's so much desire to pursue this asset class as an alternative to securities, as a way to kind of have a side gig that can really make money. There's not a lot of easy profit. You know, it's not like 2009, 2010 when there's a bunch of foreclosures, and if you just have money, you can go buy houses and you're going to make money on them just because you're willing to buy and other people aren't.
Mm-hmm.
There's not a lot of low-hanging fruit out there. Do you see anything right now? It's just like, okay, slam dunk. Like,
no, and I'm glad we're talking about this, because I actually do see lots of people when they talk about getting in this business, all they ever say is, oh, I love turning something ugly into a beautiful swan, right? Ugly duckling, the beautiful swan. And that's all they talk about, right? It's the moldy carpet in your example. But that's because, in my opinion, Mike Zuber's opinion, they're not comfortable with the numbers. Right? They can easily translate, oh, look, I painted. Oh, look, new cabinets. I feel better. But they don't live in the spreadsheet, right? You do this business because you want to make money, right? If you want to lose money, there's lots of ways to lose money, right?
Yeah, there's more fun and easier ways to do it than in flipping houses or rehabs.
Yeah. So one of the things that I teach is I teach to learn your market. Learn your market. What does your market produce for an average cash on cash return, right? As a simple buy and hold investor. And then I have a ridiculously simple deal comparison spreadsheet, because I think it should be simple. It's not, if your spreadsheet has more than like 14 or 15 columns in it, you're making it too hard. I mean, it's just, you're doing that to show off your Excel skills, not because, you know, deal investing.
Right. And you're talking to, like, you know, accountants are Excel jockeys, but at the end of the day, like, it's the key metrics and this stuff, they're not that hard. No. It's cash on cash, because cash on cash, one, you have to borrow money most of the time to, you know, or if you have to borrow money from something just to get your down payment portion, you know, or if it's not borrowing money, it's, you know, I could put money in either this fixed return sort of bond investment or in some sort, you know, in some sort of marketable securities, you know, some sort of ETF or index fund that has like a relatively predictable rate of return, at least looking over the long term. Well, that's my alternative here. Well, if I'm going to take that money and put it into this, I need to see what my bedrock numbers are. Mm-hmm. And what you see in a lot of places is, you know, especially in single family, if you don't, well, this is, I think, universally true right now. If you don't force appreciation in some form or fashion, your deal will not cash flow right away.
Yep.
We do not see that ever. I see people get into turnkey deals and stuff like that, and they are going to be cash flow negative upfront, because just in most of the country, rent to value, the 1% rule is just not a thing that exists right now unless you are dealing with very cheap properties that have all sorts of other issues. You know, because and I could buy a $45,000 house and get the 1% roll. I could buy a $45,000 house and rent it for $650 a month. But my overhead, in terms of my time, multiplies on the number of properties I have. Mm-hmm. You know, the risk of just like dealing with everything, the more tenants I have to deal with, the more bankers I have to deal with, just the more stuff I have to deal with, is not a factor exclusively of how much money I have invested in deals. It's how many doors I have, how many different properties do I have. Mm-hmm. And so, okay, yeah, I might be able to get this thing to cash flow to the tune of $75 a month or something like that. It has no appreciation upside. And in most of those places, they're deflating, and that's probably going to get worse right now. I mean, who knows? But in some parts of the country, you would think this is just going to accelerate deflationary pressure.
No question.
And so they're not going to appreciate. They might cash flow marginally, you can make money doing these things, but you have to have a system and you have to know like, hey, exactly, this is what I'm trying to do. And you're not going to have that system up front, obviously. Everyone has to buy deal one or something like that. But you kind of need to be cognizant of what you might be interested in doing. I see a lot of people that flip one house. Yeah, they've done one flip because they did it and they realized they didn't like it.
Yeah.
And that's okay.
Yeah.
But I want you to go into that flip knowing, okay, one, like if you break even on your first flip, you're doing great. Yep. Because there's so much of a learning curve in there. And this is kind of what flipping looks like. And what you see with a lot of real estate is it's like, hey, if I'm buying, let's say I can buy a single family, it needs like a light rehab or something like that. And the reason why I kind of distinguish that is like there are rental deals that you can buy that you can get to cash flow via forced depreciation, via bigger pockets, BRRRR, sorts of concepts. There aren't that many. They're not that easy to source these days. And so, especially if you don't have like a developed network of contacts. So you have to develop a plan to source those sorts of deals, or you have to kind of accept, hey, I'm going to be trying to buy break-even deals right now where I do anticipate appreciation, where I'm factoring in appreciation both in the underlying value of the asset and in the rental price as a mechanism for like, I'm not going to just make money right this second buying these things, but I think there's a very good chance 5 or 10 years from now I will. And in my worst case, I've kind of planned for it to tread water, and that'll be okay for me here. Yeah. Because if it's treading water, hey, stocks are going down anyway, stuff like that. Like it's okay if it kind of treads water versus what else I could be doing with this money. Yeah. But you have to have realistic expectations.
Yeah. I totally agree. And again, there are too many people out there buying deals out of some magic Excel spreadsheet produced by someone else showing some cash flow number, right? And it really freaks me out when people jump into a market where they have no boots on the ground and they're solely relying on someone else. That frightens me to so many levels.
I mean, because if you're buying from a turnkey company or an agent that's essentially like someone that's trying to essentially get the house to be like a turnkey property for you, well, they have to take a cut, right? I mean, because they have to have a business model too. And the reality is that there's not enough pie for everyone to share bountifully right now in a lot of these. And, truth be told, like if you're investing in real estate because you want to invest in real estate as an asset class, fine. That's one thing, and maybe owning things directly isn't the way. It could be. I mean, it just really depends on how much you've thought through it. But, if you're investing in real estate just because you're trying to diversify away from like the S&P 500, okay. That's one thing. Yeah. And if you're trying to kind of do it in that truly passive sense, and that's, that's so much of the buzzword in real estate. It's passive income, passive income, passive income. There's just not that many ways in this world where, hey, I can just deploy money and it just makes more money.
Yeah.
You read books about like the hedge fund industry and stuff like that. These hedge fund managers, they're trying to make it, wealthy people want to invest with these hedge funds because, hey, like I'm going to beat the market and I'm not going to have to do any work. And over time, it just kind of works out where, the market is the market for most people. And some people beat the market, and you hear a lot about these stories and it's like, oh yeah, these things are really awesome. But then there's a lot of people that lose, or not even the ones necessarily that lose a lot, but it's like, hey, like I'm down like 5 or 10%. Yeah. There's a lot of these like incremental losers, and those are the ones you don't hear about. Yeah. Where it's like, I did this and I treaded water for a long time, and maybe it returned 2% a year versus 10. Yeah. And it's all muddled right now because there's been this long run up. Yeah. And so it kind of masks some of the deals that haven't.
Well, I mean, you obviously know about Warren Buffett's bet. I think it was a 10-year bet against active managed hedge funds, and he just took the S&P index and won, right?
Yeah. So because it's just like every person you interject in some of these things, like, if I'm buying a turnkey company, well, the people at these turnkey company have to eat. And so every person you put in here is one more person that has to find a way to use your deal to make their ends meet. Yeah. And so if they're not really adding value in the process, if you're content with them, their value proposition, and you understand, hey, this is going to impair my return, that's one thing. And when you deal, you could have that whole same conversation about like property management companies, right? Where it's like these property managers, I'm paying them for a service. And I do come from the school that you do need to price that in just because,
absolutely,
there's a whole conversation about scale in there. and what does scale mean in a real estate context and all of that.
Mhm.
But you have to price some of these people into the process. But there's not, if you're getting into real estate thinking it's just going to be slam dunk, I'm going to print cash. No,
Yeah, totally agree.
you got to be prepared to work.
Yeah. Yeah. So really why I wanted to start here is because you see lots of deals from across the country, and there's so many people out there getting the vibe. I call it a vibration of excitement. And a lot of people even now, right? Oh my God, the deals are coming. We're going to have another '08 crash. I'm going to be ready. And I like the fact that you look at a lot of deals and people could reach out to you and maybe, see
Yeah.
what's going on.
And, anecdotally,
Mhm.
I mean, I'm in one of the hottest real estate markets in the country right
Austin,
here in
Texas.
Austin. Yeah. In terms of people wanting to move here,
Mhm.
it's not really it's a hot investor market because there's a lot of money here. It is not a hot market because there's a lot of good deals here, right? Like dealing in multifamily, for instance, all the apartment complexes around here have been bought and flipped and sold already.
Yeah.
So
Exactly.
like if you're I know a lot of people want to get into like small multifamily stuff like that. You are not going to be able to do that within 25, 30 miles of where I'm talking here in the north side of Austin, because I'm sorry, other people beat you to it here.
Right.
But like dealing in the single family space, I've talked to a bunch of agents. I live in an upper middle class neighborhood. Nothing slowed down. I mean, maybe it slowed down for a few weeks in April because, people were scared to show houses and stuff like that. And now it's just poof, it's back to the races.
Wow.
And not a lot of inventory, things moving pretty quick. Prices have not gone down at all.
Yeah.
And so you might see prices go down in parts of the country where, there's been more job issues or, now with some economic unrest or some of that. And you kind of have to decide, hey, those are the sorts of deals I'm looking to do myself. And if it is, you can build a model off of it, but you really got to want to do it.
Yeah. Well, now let's switch gears into some accounting speak. Again, a lot of folks are asking, what they want a CPA that knows real estate. And obviously, real estate from the accounting side. So I thought we'd talk about kind of the big vocabulary that they talk about. First and foremost, real estate investors get excited because of depreciation, right? That phantom expense that could hide income from the IRS. So I thought we should talk about what it is and why it's good.
So
and
anytime anyone starts saying about, I want to hide income from the IRS, you need to run from that person.
Fair enough.
Like the words tax shelter, those are dirty words. I used to work for an accounting firm that had to cut a deal with the Securities and Exchange Commission because of tax shelters and wasn't allowed to do things for a lot of time. The IRS hates that stuff. They will, and there's not a ton of that these days. There's not a ton. Like the big one would be if you've ever heard of like a conservation easement. I won't. That's a whole different diatribe. But when people talk about like that's the one thing I'm like, no, we don't touch that.
Yeah, cool.
But depreciation is one of the big tools that like Congress has used over the years to spur economic activity.
Right.
So what depreciation is conceptually is like, let's just say I'm going to buy a single family residence as a rental property, and I put in, or let's just say it costs $150,000.
Okay.
And for this purpose, it doesn't matter if I put the money in or if I borrow the money from the bank. It's the money I borrow is deemed to be mine, and the loan is just kind of its own separate animal. So I have a $150,000 property. I can't just go into my tax return and say I bought a $150,000 property minus $150,000. For long-lived assets, which real estate is kind of the example these days. It's kind of the only thing these days for reasons we'll get into. You have to recover that cost over time. For residential real estate, that time period is 27 and a half years at a base, which is, okay, I take the value of the house, and we do have to allocate, for something that has land, we have to allocate some of your purchase price to the land, and that part cannot be depreciated. But for the house, over 27 and a half years essentially on a monthly basis, you get the value of the house divided by 27 and a half times 12 on each month you own the property, and you get to write that off on your tax return. So you get to deduct the amount that you have in that house, both out of pocket and loans, over that time period. And so in that sense, it's not actually like, hey, it's not free money at all versus other forms of investments. Like I don't get to write off a portion of what I invest in stocks, right? So in that sense, it's better. But you did spend this money. Ultimately, it's a way of how do I recover this cost over time.
Mm-hmm.
So that's the basic of depreciation. And there's other things that come into it, like loan costs are separately treated for this purpose. That's kind of the big one there.
Yeah.
Those get written off over the life of the loan. If you refi, you get to write off your old loan costs.
Yep.
But then this leads us into cost segregation.
Yeah. Well, one sec. Let's just put some real math behind it, and I'm gonna do easy math just because I can. So let's assume you bought a house for $300,000.
Okay.
Right. And oh, by the way, we're going to say the land value is 25 grand just because
that's probably pretty reasonable.
Right. Makes my math really easy here in a minute, because that leaves you with $275,000. Yeah. Which, when you do depreciation cost over 27 and a half years, it magically boils down to, in this very, very, very simple example, to $10,000 a year in depreciation you can write off.
Yeah. And it looks different in year one because it is treated for, like, you come in the middle of a year, it does get prorated out. But after year one, it's going to be $10K a year for 27 and a half years.
Right. And again, it's a phantom expense, meaning it's not really a $10,000. You're not writing a check.
You're not coming out of pocket $10,000 in that year.
Correct.
It's a recovery of money that's already gone into the project up front.
Exactly. Very cool. I just wanted to give that example because some people don't realize what,
Yeah, it's easy for the accountants to, like, just get way up in the weeds.
Yeah.
So,
So if you were able to build a portfolio of real estate that's in the tens of millions, you really could be writing off depreciation of several $100,000 a year pretty easily.
It kind of, and it, how, without, like, doing cost segregation or something like that, how it all kind of works out versus cash flow is interesting. Because on a typical deal, let's say, you're 80% LTV or something like that.
Sure.
So the way a loan amortization schedule works is you're paying more interest up front, you're paying less interest at the end because your principal balance goes down.
Absolutely.
So up front, in general, your tax income is going to run it's going to be less than cash flow, because you get to deduct your interest and you're also deducting the depreciation of the principal.
For sure.
The same amount over time, even though early on you're not paying very much principal. So you kind of get to double dip a little bit up front, and tax income early on will tend to be less than cash flow.
Absolutely.
And then towards the end of a deal, as a deal ages, that reverses, where, like, the end of your loan amortization, it tends to be that your tax income is greater than your cash flow. You're paying more principal.
Yep.
And then obviously once your loan is gone, or once your depreciation is gone and maybe your loan's gone, then it's kind of just different. You're running more like what true cash flow is at that point.
Yeah.
If you don't have a loan and you don't have depreciation, you're running a true monthly cash flow.
Absolutely.
So it does tend to be that the tax benefits are better early on,
front loaded,
even without dealing with other things.
For sure. Thank you for that. So let's roll into cost segregation, because that allows, well, I'll let you go through it, right? Cost segregation is another hot topic.
Yeah, because what the purpose of cost segregation is that we've talked about real estate as this 27.5-year asset. There are a variety of components of a real estate property that can be depreciated quicker than that. Primary examples there are exterior things that aren't permanently attached to the house, driveways, fences. Those are kind of big, obvious ones. There's also a variety of interior things that can be. The issue is that the IRS does not just allow you to just make stuff up in this regard. They tend to get very fussy at people that do things like that, because the reality is that if you give people the opportunity, they're going to overvalue things like, oh, my driveway, my $300,000 house is worth $30,000.
For sure.
Probably not, but that they tend to not like that. So in order to get this depreciation into this shorter life periods, you have to have some sort of cost segregation report done. Now, fortunately, we're able, using third-party software providers for single family, or I think it's up to 8 plexes that have less than $500,000 of basis, we can do this online with automated reports.
Oh, cool.
And there are costs involved. There's costs for us to manage things. There's costs for the software. But, like if you're doing cost segregation in an apartment complex, you have to have an engineer come out and do a study. And it's going to be $5,000 at a minimum, and typically more than that, kind of depending on the size of the property. Whereas we're talking hundreds of dollars, 3-digit numbers when we're dealing with single family.
For sure.
And the big upshot these days is there's this concept called bonus depreciation.
Yeah.
which is really, instead of, my driveway, instead of depreciating over 15 years, any asset that has a depreciation life of less than 20 years under current tax law, you can write off 100% in year one.
Yeah.
And that's where you really win with cost segregation right now, is because in this example, we'd probably be able to find $25,000, $30,000 a year, or $25,000 to $30,000 of upfront costs we could write off in year one.
Absolutely. Yeah.
Now, there are caveats to this. There's not caveats in terms of the depreciation amount. That's legit. But just because I wrote off, hey, I get to write off $30,000 depreciation this year, and I'm going to use that so I don't pay any tax on $30,000 of my W-2 income. Well, it doesn't necessarily work like that, right? Because there is this fun concept called the passive activity loss rules. And rental real estate is generally deemed to be a passive activity. And what those rules say is that you can't have a net loss from your passive activities for the year. You can't deduct a net loss on your passive activities for the year in general, because they don't want people doing exactly this. I'm going to just go invest a bunch of money in this real estate deal. I'm going to create this large upfront tax loss for whatever reason. And then I'm actually, I'm borrowing that money from the IRS from 30 years from now.
Mm-hmm.
There are limits on that. There are two ways around this in this context. One is that for people with adjusted gross income, which is a specific tax calculation concept, but if you're a person that you just have W-2 income and rentals, essentially just think about it as, how much W-2 income do I have is kind of a good baseline for what adjusted gross income is.
Mm-hmm.
If your adjusted gross income is less than $150,000, you do get to deduct some of your net rental loss. It can be up to $25,000. It starts phasing out as you get closer to that $150,000 threshold.
Mm-hmm.
So for people, in that income level, you do have the opportunity to utilize a net rental loss to get a bigger refund right away. I was working with a client of ours just last week where it's like, hey, like if we do a cost segregation study, like I've run the numbers here, I'm estimating we can get you like $3,000 back like right now that you wouldn't be able to get otherwise.
Yeah.
Even through the loss suspensions, we can get more. We're going to probably get that much more next year also, because they're in the position to write this stuff off. It's not all getting suspended. Now, to the extent it gets suspended, it does get carried forward to future years.
Yep.
So a lot of times what we're looking at doing for people in this situation is that, hey, like we're going to do this now. We offset some income right now, or maybe even potentially not. But what we're going to do is that instead of having this depreciation over 27.5 years, we're building up this loss that we can use in year 2, year 3, year 4. So we're kind of ensuring that over the next few years, we're not going to pay any tax on our net rental income. Mm-hmm. And that's a lot of times what we're trying to do is, hey, we're trying to make sure that we get, 5, 6, 7 years into this and we're not paying any tax. And depending on how an individual person continues to buy properties, you can roll that forward forever if bonus depreciation sticks around. Doesn't seem like Congress is going to get rid of it anytime soon. It keeps coming back. Right. So,
yeah.
And for those people, hey, we're trying to build up this buffer. And so obviously the net point of this is that we have more tax money now, or we save tax money now so that we can keep doing more deals.
Yep. And
if you keep reinvesting, it can potentially keep self-perpetuating.
Mm-hmm. Yeah. So you talked about, yeah, there you go. The other way. Yep.
Yeah, because this, where I'm going with this. This is the real estate professional status,
mm-hmm.
which is if you are a real estate professional, quote unquote, then real estate activities are no longer considered to be passive. And if they're not passive, you can deduct a net loss.
Mm-hmm.
This is a bright line test in the Internal Revenue Code. There's not that many things where the IRS is like, this is exactly what you have to do in order to qualify for this. They like to bury it behind things like facts and circumstances and things like that. But for the IRS, when it comes down to, are you a real estate professional? It is, do you spend 750 hours a year on real estate? And is this your single biggest income earning activity in terms of hours worked? So it has to be 750 hours a year. And yes, they can make you track this. Yes, you might be asked to produce a log. Like they can make you prove out your number in this regard. It's not just hypothetical. Because again, people tend to overestimate the number of hours they spend on this.
Mm-hmm.
And it has to be more than whatever else you're doing, be it a W-2 job for most of you guys, or if you have some other kind of business, you have to be spending more time on real estate than this W-2 job or your other business.
Mm-hmm.
W-2 job, this tends to be a very, very difficult test to pass. Is this, hey, if normal W-2 job, you're working 40 hours a week, you're working 2,000 hours a year.
Yep.
Well, are you working 40 hours a week in real estate? Honestly, I hope not.
Yeah, me too.
Because that's going to be a tough life. So,
yeah,
a lot of times what you see people do is if you've got a married couple, one spouse is working and the other spouse is trying to be the real estate professional.
I've seen that.
That's kind of the most common. Now, if you're someone like, if you're a real estate agent or you do flips for a living, or you're connected into real estate somehow, then obviously that makes it a lot easier to use these losses from buy and hold rentals.
Mm-hmm.
The other big thing here, and you could have a whole other podcast or a video on like flipping and stuff like that. These concepts don't necessarily apply. Most of the stuff we've been talking about here doesn't apply to flipping. We're talking about buy and hold real estate when we're talking about everything I'm just talking about.
Yep. Yeah. So I want to hit it again because a lot of people watching this are in the kind of 8 plexes and below. You talked about maybe doing a cost segregation for them, talking about passive activity loss, real estate professional status. How can people reach out to you again? Because again, I think people need to be calling you to see if you can help them.
So you can call our office anytime at 512-246-9669. You can reach out to me, Evan Kirkpatrick. We're on Facebook. We're on LinkedIn. Feel free to message me on either of those. Connect with me there. We post updates on different things as we go. We have been doing videos throughout the spring, a lot of stuff for small businesses, the Paycheck Protection Program, EIDL, all sorts of different fun stuff the government dropped on us. You can also email me at ekirkpatrick, so EKIRKPATRICK at kirkpatrickpllc.com.
And again, I will put his email in the first line of the description. Evan, this has been a lot of fun. Lots of stuff going on. Hopefully we can get your phone to ring because I am not going to answer accounting questions. They are going to go to you. I do not play outside my lane.
If you're not, and this, we see this all the time with people. It's like, I've prepped my own tax returns historically, something like that. If you're a smart person and you're dealing with like 1 or 2 single family rentals, you might be able to get away with it. But all the stuff with depreciation and getting your cost basis right and all that stuff, that's year one stuff. Yeah. And that's the easiest stuff to make mistakes with. And we see it all the time.
Yeah. Again, folks, if you're watching this channel, we brought Evan to the show because one of the subscribers recommended him. He's clearly knows what he's doing. He's seeing deals. Part 1 was looking at deals. Don't just vibrate and get excited. Point 2 is really understand what you have at your disposal with bonus depreciation, cost segregation, real estate professional, passive activity loss. There is so much stuff there. Reach out to Evan, buddy. Thank you very much. Have a great day.
Thanks for the time, man.
You got it.